All right, Portfolio Builder members, thank you for joining us live. Last day of 2019, we are playing emerging markets because it is Tuesday. And if you already own the emerging market position and put option protection, you have no action today. If you're just entering into your emerging markets position, then you will want to protect it from downside risks with the January 10th, 2020 4423 put option. And that's one put option per 100 shares of emerging markets. Emerging markets represents 10% of our total portfolio allocation, and it's really critical to track the emerging markets for the thesis of our entire strategy going into 2020. So not only can this add a lot of profit to our portfolio relative to the SPY, it certainly could outperform the SPY. It's also critical that this ETF does well. Otherwise, we might be headed towards another repeat of 2018. And that's where world stocks did terrible, and it eventually caught up to the US economy. So let's take a look at today's trade alert. You can see we have a unlimited upside potential because we're long emerging markets, but on the downside, we have absolute protection. And essentially, we're going to lose the difference in the current trading price versus the strike of our put plus the premium. So that's the maximum loss going into this trade. Let me pull up the real-time risk graph so we can look at it. So if we do look at folks entering the position today, your maximum loss is just under 2% through January 10th. So that one put option gives you the downside protection for the next, well, that's 10 days. And we will be continuing to do similar trades after we get through these holidays. So most likely we'll be doing the super wide option collar after this put option does expire at the end of not next week, but the week after that. So the idea is that we need to pay off the put option from emerging markets appreciating before the expiration date. And that's how we can generate a profit with this current trade setup. So if we do look at our trade alert, we can see our open positions. We entered this position on December 17th when emerging markets was at 44.21. It's currently at 44.72. And this is for folks who've been following us for quite some time. So we actually had to pay off a much more expensive put than you would following today. And that's because the clarity on the trade deal was not so clear several weeks ago. And again, our program likes to play it safe, be skeptical, and always be precautious. So we had to pay off 61 cents on our put. And today we are currently in the green by 18 cents. A lot of that is still held in the value of our put option. So we're seeing emerging markets rally for the past month, and it's still struggling to break through a tough resistance level. The news out today is that we will have a signing ceremony January 15th, which is odd because their premiere is flying out this weekend. So what's the delay? Perhaps they're still spending a lot of time comparing the Chinese translation against the English translation, which is really fascinating to think about when you consider the two languages are so much different. And there's probably not a verbatim word for word translation. So that's interesting. And I wish I spoke Mandarin to be able to get into those details more, but unfortunately I do not. The next open position we have that is absolutely on fire is our GDX position. And we sure wish we hadn't bought the downside protection on that one. Now, when I entered this position for our clients, originally, the gold market had been selling off for months, despite rate cuts and a heavy dose of about $100 billion per month added to the Fed's balance sheet. Those are the two magic ingredients we like to have to be long gold, which is really just irresponsible actions by central banks. And that's happening at record pace right now. So it makes sense that gold is catching on fire and traveling higher right now. So we had to pay off, in this example, a $1.15 put option So we'd actually be up more than twice this amount right now, or be showing an open $7,000 profit in the past 11 days, just 11 days, had we not been so precautious with this portion of our portfolio. But at that time, it just had not been providing the price action that correlated with our fundamental analysis. So, oh well, we're still up 91 cents per share. And again, this is a 2-to-1 ratio of gold against the SPY, or GDX. Now, we're not playing spot gold, we are playing gold miners. So this is our best performing position currently, and actually the position I believe that will be the leader in the markets for 2020, 2021, and probably into 2022. What will be the nail in the coffin for gold? Most likely it's going to be when there's inflationary fears that cause the Fed to begin hiking interest rates and maybe even doing quantitative tightening. That could be a long ways off. So we'll see if we get any hint that the Fed wants to raise interest rates, but I highly doubt it. My bet is their next move will be to zero in 2021 after the election is complete and we re-engage into phase 2 of the trade war with China. And my expectation is we'll be in a long-term trade war with China for the next several decades. So the better part of my career will most likely be spent understanding the key relationship between China and the US. Moving along, we have our TLT position, which we are short. So we're betting that yields will rise in the bond market to continue attracting capital to fund the US government. And it's critical that the US can begin getting a lot of foreign investment. Otherwise, the Fed will be absolutely required to continue expanding its balance sheet, most likely somewhere around $100 billion a month, almost indefinitely. So at some point, the yield will get so attractive that it will put pressure off the Fed, off of US banks, off of US broker dealers, and start pushing this debt back to foreign entities. So that's the big move I see happening in the bond market. And if we really look at that relationship between bonds and stocks, the market is extremely overpositioned in bonds still. So the best chance for a rapid rise in the SPY and a rapid decline in the TLT is probably Q1 of 2020. I'm expecting in Q2 for everything to really slow down. So I'll expect those yields to begin slowing down, as well as the growth on the SPY, until it causes itself to eventually reverse. So we'll see just how fast that occurs. And we'll take a look at the yield curve, as always, in a moment. Currently, we're flat. We're up pretty big on the TLT. My only explanation for why the TLT keeps bouncing up and down every other day, we have either a large loss, a flat, or a huge gain. And I think there's just simply a lot of emerging market debt, and especially European debt, that's getting out of low yielding bonds, and it's forcing itself to buy anything with a positive yield. So primarily China has positive yielding debts, but their accounting is a little bit shady, to say the least. So really your most attractive bond to purchase at this point in time is your US products. And that's the whole range from high yield junk debt to investment grade debt to US treasuries. They're all still holding on to relatively low yields at this point. And I don't think it's going to last long. We're also probably seeing a lot of year-end accounting tricks. So they may be taking some profits on the SPY and also selling some of their losing positions to offset that P&L. So I think we're just seeing a little rebalancing today. I'm still very bullish on the SPY. Currently, our SPY position is down 48 cents from yesterday, with the bulk of that being in that long call option that carries us through Friday. Net, we lost 0.1% day over day. So we pulled back a little bit on our TLT position, but we gained on our GDX position. That really summarizes how our portfolio's performing from yesterday through today. To remind everyone of our trading plan, we trade the SPY Monday, Wednesday, Friday, emerging markets on Tuesday, TLT, and GDX on Thursday. The proper ratio is a 2-to-1 ratio. So if you had 300 shares of the SPY, you would want to eventually own 600 shares of emerging markets, 600 shares of TLT, and 600 shares of GDX. Now, this exact trading plan and set of ETFs is probably your best bet for the next 2 decades. There's really very little chance that any other country will become more important to study, focus on, and have in your portfolio than China in the near future. So maybe India will start to outpace Japan, but still Japan and India are far behind China. And emerging markets does give us exposure to India, China, Korea, and a whole bunch of other countries. So between the SPY and the ETF, you have 1,500 equities in your portfolio, extremely diversified, low business risk. Can't have hedge funds come in and crush your stock for a few days. So it's a very safe way to allocate your capital. And when you add in our options, it makes it extremely safe. Now, currently, we are short on the TLT and long on the other assets. So the TLT is not providing that cushion for us right now. And that's why I'm playing the SPY and emerging markets as well as gold extremely safely with extremely tight put options very near the current trading price. We've all seen these charts a million times, so I'll skip through that. The next part of the trade alert is just a step-by-step visual. So again, if you took the last week's put option, you have no changes today. If you're just entering the position, you want to buy to open your January 10th, 2020, 44.23 put. And the reason that strike looks funny is because that was a dividend day. Normally it'll just be a flat strike. Here's our risk graph once again. So we have limited downside risk around 2%. Now remember, that's on 10% of your portfolio. So the worst case is between now and January 10th, we lose 0.2% of our total portfolio. On the other hand, if we can pick up 2, 3, 4, 5% gain on emerging markets, well, just divide that by 10. So it does give us a very nice risk to reward ratio going into 2020. Now, I was doing this longer expiration put so that we could have a lot less work during the holidays. Not next week, but the following week when this put option gets near its expiration, expect to go to the wide or the bullish option caller, as that is a little bit easier for us to broadcast to our members and keep everybody on the same page. So we'll probably be doing a super wide option caller emerging markets for the bulk of 2020. Now, if we see emerging markets not keeping up with the SPY, that's going to be a very alarming signal for me that we may be wrong on our expectations of benign growth in 2020 and a pullback in the bond market. So again, not only is emerging markets a great opportunity for us to get a little extra return in the equity side that could outperform the SPY, it's also a great key ETF to focus on, because if China's not rebounding, the rest of the emerging markets are not going to rebound either, and eventually that will catch up to the US. Now, in the short term, we've seen what happens. Money flows out of foreign countries into US products as a safe haven, not for a great investment, but as the best opportunity out of a lot of bad opportunities. So this, again, is a very critical ETF for us to follow. We'll go ahead and jump into the charts, and then we'll open up for Q&A. Okay, so we've been predicting a bullish SPY ever since the phase 1 trade deal was announced. But as you know, I was highly skeptical that we would actually get the Chinese to at least agree to sign any sort of deal. And they've been a little bit shady about their language relative to the phase 1 trade deal. But in the last week especially, it's been very positive. So it does seem like China wants us off their back. If nothing else, I think the PR smear campaign on China has done more damage to their economy as well as to their rule of law for the Communist Party than the trade war perhaps did, or the tariffs. So I think that's really perhaps one of their biggest fears is food inflation, which causes social unrest, the protests in Hong Kong, which is critical for their ability to raise capital. And now the whole world thinks that they're an evil group of Nazi-like communist people creating concentration camps. So they're doing a lot of work to try to rebrand themselves into 2020. And so because of all of that, I'm now in the camp that I do think we have a period of peace with China in 2020. On top of that, there are two Democrats that could have been in the bag pro-China are Bloomberg and Joe Biden, and their chances of election are looking slim to none. Whereas the rest of the Democrats who are pitching are getting even more negative on China than Trump is, at least in recent weeks. Okay, so when I do look at the SPY, I think we have a lot of upside, and this is primarily because of a few items. Number one is the government, the US government is creating around $100 billion a month of debt that it can't fund from tax receipts. So with a $2.55 trillion budget, we're short around $1 trillion. You throw in a few disasters, that'll tack on another $200–400 billion. There's about $1 billion plus, or rather $100 billion plus of unfunded treasuries that have to be sold. And our US banks, the primary dealers, have to buy that debt if no one else steps up to the bat. So the big picture is we must get these yields attractive to take pressures off the US banking system. And so for that to happen, those yields must rise, and that's going to cause a lot of disruptions in bond markets overseas. So if you look at it that way, that's really the core reason I'm super bullish on stocks. I think that rising yields on the TLT will disrupt bond markets, especially in Europe, where they have low yielding debt. And at the same time, until the foreign entities do pick up the tab on US debt, it's going to force the Fed to continue expanding its balance sheet. And we can see almost a one-to-one correlation in the growth of the balance sheet to the value of the S&P 500. It's amazing and now not even disputed. Here's a look at your long-term chart on the SPY. Now, do I think there won't be any volatility? No, of course not. And that's why, even though we're so bullish, we're playing it in a very smart manner with a tight option collar and a little cherry on top with a call option. That allows us to catch a lot of the upside move with almost unlimited potential gain. But when there are sharp sell-offs, we're not going to get nailed. Now, also during this period of time, we're not going to have that long position in the TLT to really protect us from downside moves in the SPY. So that's why we have to play the SPY very intelligently with a very tight option collar and then capture gains with our long call, which is what we're in right now. Here's a look at your TLT bumping up and down over the last 5 days. If we do look at the bigger picture, we can see that avalanche is forming. And if we get something like we saw in this chart right here, towards the end of 2016, it can fall off a cliff. And so we're trying to be positioned to capture that move. Now, I don't think it'll go as low as we saw in 2018. You got to remember, in 2018, we were doing quantitative tightening and hiking interest rates. So that was a lot of pressure to get those yields that high. This time around, the Fed's expected to stay flat. And it's simply a rebalancing where we were fearful of a recession in 2020 due to US-China relations. That's completely gone away now. There's really no big fear to be scared of. And also, we don't have our government trying to tighten its budget, which is directly correlated with GDP. So we're going to grow our GDP at the expense of growing our national debt. And so all those factors add up to me for a pretty sharp sell-off in the TLT. So my target is around 120. I think that'll be as low as we go until the Fed is forced to cut interest rates. And that's what gives you your next big bounce on the TLT. As far as how high it can go, my expectation is we top out somewhere in early 2021 as we enter into a new trade war with China after the election. I think it can travel as high as 180 if we put a floor of 0% rates. Now, if Germany and other European core economies can drive their yields and continue to go into negative territory, especially Japan, more so than they did in 2018, then perhaps we can actually, or rather 2019, then perhaps 180 won't be the ceiling. So I'll be paying very close attention to the Fed minutes and all of their dialogues and public speeches to get a hint as to whether or not they'll be willing to go into negative territory. Emerging markets finally starting to catch up with the SPY, rallying considerably in the last month, which is good for our thesis that we should be long stocks. But you can see it's had a troublesome time over the past decade. So as far as an initial target, 52, that's where the last high was for emerging markets. With all the quantitative easing happening and a release of the trade war, I think if we start to see China really living up to its agricultural purchase promises, and we see tariffs being rolled back as the US is promising, this could break out of the 42 level. So it has a huge potential gain from here of at least 10%, maybe 20% or more, as long as everyone's playing nice and continuing to be expanding their debt levels. GDX is rallying in the past 5 days. This is our best performer currently in our open positions. If we look at the big picture, it's just getting started. The debt that was causing problems in 2008 is at least double, if not much more larger in 2020. And if we look at the bad investments in the US from the housing crisis, it's been estimated around $300 billion. Well, the amount of misallocated capital in China is probably in the trillions. So depending on when they want to allow those debts to be realized as losses, we're really going to see the pain come out of China. And to continue trying to bandage that, the formula has been to continue increasing debt. So as long as that continues, we have all 4 central banks and major economies doing the double no-nos. They're expanding debt in the government debt, and they're also expanding the bank balance sheets. So we have a lot of reasons to be long gold, and I suspect this will last for between 3 to 5 years. So I do think it can outperform that 66 level we saw in 2012, which occurred after QE2. What could go wrong? Well, why on earth did JP Morgan pull $200 billion out of the repo market? We don't really know why. So there's a handful of banks that I know are a high risk: Deutsche Bank, HSBC, Santander, this is your car loan, and then SoftBank. So I'm keeping an eye on any of these crashing. Insiders here would certainly know if something bad was about to happen. So far, the coast is clear on that today. Also, I'm looking at a number of different bond proxies through ETFs. The one I think that will really crack the stock market is LQD. That's your investment grade corporate bond fund. And nothing is really selling off today. So whether you go to emerging market debts, junk bond debts with HYG, if we look at any part of the treasury curve, not crashing yet. The TLT is really the one that's selling off the most, but it is rebounding a bit this morning. If we go to iGov, looking at a lot of your European debt, nothing selling off yet. So the credit markets are remaining tight. LQD is at an all-time high. If LQD is at an all-time high, that means companies like Microsoft, Apple, Amazon can essentially get near free loans to buy back their own stocks. So you tell me, if they're the main buyer of stocks that has driven this 5-year rally with over $5 trillion in stock buybacks, what's going to stop this? This chart must crash before we want to bet down on the SPY for more than 3 months at a time. It's just as simple as that. HYG is your junk bond, or really correlated to the Russell 2000. It's even starting to break out of that resistance level. So this is all pointing to cheap credit for equities and probably record-breaking stock buybacks into 2020. Now, why is gold rallying so hard? And why is emerging markets doing well? Well, we needed a softer dollar for both of those to occur. And sure enough, the dollar's beginning to weaken. Now, a tight dollar that's rising is disastrous for emerging markets because most of their debt is denominated in dollars. If we look at the big picture, we continue to have a hard time getting over that 100 level on the dollar. And that's actually really good for our thesis going into 2020. We don't want a strong dollar. If it were to be breaking past 100, I would not be betting up on emerging markets or down on the TLT at this point. So that gives people a little bit of an idea why study the currencies. Crypto is a good indicator of whether people trust their government and the rate of inflation, as well as confiscation risks. So these are still remaining at elevated levels. And we currently recommend no more than a 2% total allocation in crypto. So if you've had a big gain this year from following our alerts back in December, you're probably up to a 6% position because we got in at very low prices. So you should be taking profits and maintaining no more than a 1% total position in Bitcoin and a 1% position in Ethereum. And that's at all times. Do not let that position get bigger. As these go up, take profits. As they go down, add to the position. A lot of our folks don't follow this because they have that large gold position. For me, gold and Bitcoin are one and the same, just a riskier option. And that's why we have a much smaller position in these two if you do follow our alerts. Now we can see an interesting correlation. The second that phase one trade deal was signed, we've seen a reversal in currencies. We've seen the dollar weakening against major currency pairs. So we can see the euro and we can see the yen. Another currency we're paying attention to is the Hong Kong dollar. If this currency peg did snap, that would be disastrous for China and probably for all countries surrounding China. This is Kyle Bass's big trade, and we have seen it strengthen to a level that it's really been at for the past decade. So we're keeping a close eye on that. The protests in Hong Kong are not dying down whatsoever. So the longer this goes, if we can get back into re-engaging in a trade war in 2021, this could be a very lucrative trade to short the Hong Kong dollar. Currently, we're still on pause, and I continue to watch the developments in Hong Kong. The Chinese currency is strengthening against the dollar, which we can see in this chart. And if tariffs do begin to roll back into 2020, it could get much, much stronger. The big picture, though, is that this currency is tremendously overvalued, and China wants to spin their currency for their Belt and Road project or initiative. In order to spin their currency, they're going to have to open up their capital flow, which is very restricted currently. So my expectation is in the next decade, this will devalue probably to half. So you could see this devaluing to 14 in the next 10 years. And so 2020, probably a good opportunity to be short the dollar against the Chinese currency. I'm not putting that trade on because I know it's tremendously more leverage to go the opposite direction. And any breakdown in China's economy, the Hong Kong dollar, or the US-China relationship could cause further devaluation. So we're still patiently awaiting the opportunity to jump into this trade in our boot camp. Here's a look at crude continuing to increase in cost. This is definitely worrisome for bonds as it creates inflationary pressures. So it does go with our thesis of being long stocks and short bonds at this point in time. If we go back to 2018, just after, well, actually just before we had the stock crash and the reversal and bond yields going super high and then crashing back down, we did see oil continue to go higher and higher. So the same correlation we saw play out in 2018 is playing out right now in 2019. Gold is strengthening against a weakening dollar. Now in our boot camp, we have a few copper stocks that are doing well, and we're watching the potential rise in copper prices as a similar play as being in gas and oil companies. Now, why are we doing copper? There's a little bit of a bigger long-term demand and less supply in copper for the electrical vehicle industry versus the overdeveloped oil and gas industry. So that's why we're playing copper instead of energy stocks like Conoco or any big oil rigging company. The German bond on the 30-year is my best leading indicator for the TLT. And remember, if yields are going up, TLT is going down. So the clear trend for the German bond is straight up currently. And again, this is another good idea of how's China performing. If China is crashing, these yields will be tanking. And so while we can't exactly trust the data out of China, we can from Germany. And so again, I believe these yields will continue to rise until we get to a tipping point. And we can see that correlation in our 30-year treasury right here, climbing up as well. Now, how high could this go? I don't think we're going to get as high as 2018 before it causes stocks to sell off. And you can see this 30-year got up towards 3.5 until we had that stock meltdown at the end of 2018. This time around, the forecasters at Bank of America believe if the 10-year gets to 2.8, that could cause trouble for stocks. So we'll be carefully watching yields rise into 2020 before we change our predictions. Okay, here's the top news, and then I will open up for Q&A. Donald Trump, I'll be signing our very large and comprehensive phase 1 trade deal with China. One second. On January 15th, the ceremony will take place at the White House. High-level representatives of China will be present. At a later date, I will be going to Beijing, where talks will begin on phase 2. So he could not get President Xi to sign it. Interesting. Trump said high-level representatives of China will attend the signing. He added that he will travel to Beijing at a later date to start phase 2. This is just a classic movie. I'm not saying to sell stocks, of course, but this popped up in my feed today. Trading Places with Eddie Murphy, great flick. Party like it's 1998, a quarter of 3.2 trillion in triple B rated bonds. Credit rating agencies have been paramount in creating bubbles and misallocation in the past. Last big time we did this was in the housing bubble, with taking a bunch of housing loans, packaging up as a safe investment and selling it to the public. And the reality was those were loans that banks shouldn't have made. And this time around, it's happening primarily in corporate credit. So that LQD could potentially be a massive winner to short when the time's right. And probably that time is not yet. So continuing to watch LQD like a hawk. A lot of people like to say the bond market is telling the Fed what to do and the Fed's just a puppet of the bond market. I've never believed that. And as you can see in this very cool chart, the bond market's always off. They're always predicting something completely different than what actually occurs. So just an interesting chart. Again, our expectation is flat into 2020 until yields get too expensive and causes a stock crash. And then that's when I expect they will cut rates and then eventually move into QE. And this is very handy for banks. So from the banker's standpoint, and remember, the Fed is not owned by the US government, it's owned by the banks. So from their point of view, they see this obligation to purchase debt for the foreseeable future at record amounts. So they want to be able to buy that debt and sell it to the Fed and not the open market for a profit. The only way they can flip the bonds is if the bond yield goes dramatically lower. And really the only thing that causes bond yields to go lower is typically a crisis paired with lowering interest rates. So that's why it's quite hard to not predict that we do not lower yields and go into some form of a crisis to dump this debt and create a large profit for the banks. Okay, now we're looking at US political news. The Democrats will do anything to avoid a trial in the Senate in order to protect sleepy Joe Biden and expose the millions and millions of dollars that Where's Hunter and possibly Joe were paid by companies and countries for doing nothing. Joe wants no part of this mess. Fox News dominated the basic cable news industry in 2019, 2.5 million viewers during prime time. Competitors include ESPN with 1.78 million, MSNBC at 1.75, CNN has been really dropping in viewership at 972,000 viewers during prime time. So Fox now has almost 1.5 times the viewership. Fox News's Hannity was the most popular news show with 3.3 million viewers during prime time. Tucker Carlson with 3.1 and Rachel Maddow in third with 2.78. So if that gives us any indication for predicting the election, it's definitely in Trump's court at this point in time. Just showing you perhaps the injustice in the U.S. Government and prisons, or rather police and FBI and all this. Epstein commits suicide despite constant surveillance and being on suicide watch. Gosen flees Japan and becomes a global fugitive despite being under constant police surveillance and house arrest. This is over in Japan, and apparently he hid in a instrument case and got smuggled out of Japan. Finally, the White House will become a trading floor. This is a joke from Zero Hedge. Mike Bloomberg, as president, I'll turn the East Room into an open office plan where I'll sit with our team. I'll use the Oval Office for some official functions, never for tweeting, but the rest of the time I'll be where a leader should be, with the team. And a photo of him right there in the middle inside of his New York office for Bloomberg. Moving on to news related to China. Huawei's revenue hit $122 billion record in 2019, despite the US campaign. China is, I've never seen this before, but this gives you an idea of what their foreign reserve looks like. So 21% of it is in the USD, 17% in the euro, 11% in the yen. So it's interesting to see this basket of currencies they hold. JP Morgan Chase and Company is seeking 100% ownership of its futures JV in China. So we are seeing US banks starting to partner up with China, which they desperately need to increase their debt, not by expanding the UN, but by getting other investments, which they've had very few of. And again, they need about $3 trillion in the next 10 years to fund their Belt and Road Initiative. Another reason they might play ball with the US. Hang Seng Index gained 9% in 2019, despite the US-China trade war, but 7% of that was in December. So it does look like Chinese stocks are starting to get a bid, which we want for our current outlook. Huawei has toughed out one of its trickiest years in its 32-year history. In the past year, U.S. officials handed down a pair of criminal indictments of the company, added Huawei to the Commerce Department's trade blacklist, and placed new restrictions on its ability to sell to small American carriers. It's also pressured allies to exclude Huawei from 5G network rollouts. You can see its revenue growth is just exponential. But I will say that the revenue from Apple in just Q4 is 60 billion, which I have in the next slide. And its profits. Now there's a big difference. Huawei doesn't make a profit. They're selling their phones for a loss and using the Bank of China to subsidize these losses. Meanwhile, Apple is a cash printing machine. So just parallels these two superpowers in the phone industry. Meanwhile, there's a doctor that was arrested in China. And I want to know what that was all about, but there's some doctor in China who took a parent who had HIV and a mom who did not, and edited the baby's genetic code, and the baby came out without HIV. He ended up in jail for 3 years. This was the news hitting yesterday, but just goes to show some of the crazy things happening around the world. China's PMI is starting to strengthen, so we are seeing some signs of life in China, alongside that rising yield in Germany. And we're also seeing a credit impulse pop to the upside in China. So this is all good for emerging markets position. New manufacturing orders picked up. The last time the reading was above 50 was May of 2018. But the improvement in manufacturing was concentrated in large and medium-sized enterprises, with small enterprises plunging deeper into contraction. And that makes sense in China because the larger companies get a lot of handouts from the government as their core strategy for taking over key industries. The potential de-escalation of China-US trade tensions improved global manufacturing demand, inventory restocking driven by lessening demand headwinds, and accelerated infrastructure investment growth in China may continue to support a moderate cyclical recovery. So this is really key to follow going into 2020. I had this slideshow of the trade war, but it's too hard to read, so we'll skip through that. But this is a really cool chart that shows how the trade routes have changed since the trade war. And so we can see US has had to reroute its agricultural and petroleum products to Europe, Japan, Korea, and Southeast Asia and India. And meanwhile, China has rerouted its orders from Middle East for most of its energy needs. And also it's purchasing agriculture from Brazil, Argentina, and as well as some natural gas from Australia and Malaysia. So a lot of trade route disruptions in the past year and a lot of rerouting. So just a fascinating picture to see how that's all playing out. Okay, if we look at our yield curve, I want to remind everyone what happened in 2018 is stocks rose. We can see the yield curve. Let me just go back in time. Okay, here's the one we want to look at. So the blue line right here, ignore, that's current. But what happened in 2018 is stocks rose, also yields rose. And once they got above 3% in October, we had a stock crash when the Fed came out in December and said, hey, we don't care about the stock crash. You guys are overreacting. We're going to continue quantitative tightening and increasing rates. Well, that's when we got the Christmas massacre. And what happened shortly after bond yields came back down? The Fed began cutting rates into 2020, and now you can see where we're at today. So these yields on the 20-year and 30-year are going to most likely climb back up towards this 3% range before we see some serious trouble, at least due to the bond market causing sell-offs in stocks. So that's what we're looking for and why we're currently short the TLT. Now, if we go to current time frame, let's look at 2019. You can see in January, yields were way up here. By April, they began to go lower. By June, we got rate cuts and an inverted yield curve. And Fed does not like inverted yield curve. That scares people, it messes up the way banks work. By August, the yield curve was extremely inverted. And then in September, they had their infamous meeting, which is when they began buying treasuries. And you can see what happened in the next 3 months. They did massive purchases on the front end of the yield curve. And they've essentially forced this part of the yield to be low and allowing free market forces on the notes and the bonds. And so we can see those are beginning to rise. And I believe that trend will continue until we have a new crisis or we have new rate cuts. So without the expectation of rate cuts and without the expectation of a trade war with China, these yields will most likely float back towards that 3% plus level and then cause some disruptions. Okay, so that is a wrap on the current trade alert. Let's see what we've got out there for questions. Okay, great presentation. Question about the desired reserves we should keep available for opportunities if LQD was to become an actionable event. What amount of capital would be necessary? Yeah, so I'd be playing that with put options with no more than 1% of our portfolio. So yeah, you'd want to save 1%. That would be a boot camp trade alert on a Friday. So Friday, I give out special riskier trade alerts to our boot camp members. So if you're in the boot camp, that's where you would expect to see that trade. And most likely, sure, I'm going to be watching it like a hawk, but I don't see LQD really tanking yet. Not until there's a fear of interest rates going higher. Right now, the fear is interest rates will go to zero. So I think we certainly want to keep a close eye on LQD. But I'm concerned that we may be a ways off. So that's why we have not entered any positions. So for that, I'd want to see the TLT really starting to tank. That'd be a good sign. And then I'd want to see LQD starting to sell off. And at that point, I would jump into a put option on LQD. Now, it could be that we see the junk bond start to sell off first. So that's why I'm also watching that one. Usually your weaker market will crash first. That's why we saw emerging markets sell off starting in 2018 and then eventually caught up to the US. But this time around, it might be a little different. Let's look at these two charts. So HYG may end up with a big basket of the bonds that are misrated in LQD. So that's really Gunluck has been predicting this, is that there'll be a group of corporate bonds that are about 25% of this entire ETF. What's held in it will be suddenly re-rated into HYG. And funny enough, almost all of the liquidity in these bond products are traded through these two ETFs right here. So investors don't realize how illiquid these bond products are if there's a crisis. So yeah, certainly if we do see the sell-off, we will jump into some puts to get leverage with low risk. So either one of them or both, I'll be very excited to short. Yeah, exactly. We have a handful of really attractive opportunities in our boot camp. Currently, we have some English banks and some copper stocks that I believe will give us a very, very handsome return in 2020. But you're right. Once the opportunity does come, this could be much more lucrative and short-lived. It'll be a quick crash. You can see how quickly this crashed in 2013, 2016. Sure. Go ahead, Mark.
Yeah. Can you hear me?
Yes, sir.
Okay. So I have a question about the allocations. So you've got 100 SPY and then 200 of the other type of things. Now, if the amount that we're putting in, let's say it's 8 times this, so it's 600, then that really gets you 700. So 40% at the current SPY price gets you 750. So I'm assuming I would really just round down to 700. But the EEM and TLT, it ends up at calculating close to the 1300 and 1600 and 2000 for GDX. So should we just stick with the SPY as our benchmark number and then double off of that SPY number and not worry about whether we're a little bit high or low on the others?
Yeah, exactly. Because number one, you do need the even lot of 100 to do the options, and then two, we're not just long these products, we're also directionally trading them individually with the options. So certainly if you had 600 shares of SPY, then you could do 1,200 of the others. Now, if you want to leave anything out because you wanted to work a little less, you could, if you were to remove two things, I would remove the two smaller positions, emerging markets and GDX, and then just trade the SPY and TLT. But honestly, I really think gold is going to be a great returner in 2020, but probably the top performer in 2021, 2022. And that's based on when I think the Fed will cut rates to zero and then go into real quantitative easing versus they call what they're doing right now. They call this, they say, whatever you think, this is not quantitative easing. And the reason they justify that is because these debts roll over so quickly that they're going to have to just keep rebuying the same duration, and it's not going to make their balance sheet grow at such rapid pace. So unless the foreign investors come in, this scheme is not going to work. They're going to have to continue to expand their balance sheet very aggressively. So they'll continue to purchase this short-term debts. But if we don't get foreign investors attracted to the yields on the 2, 3, 5, 7, 10, 20, and 30 year, now they're talking about a 100-year bond, then they're going to have to aggressively grow their balance sheet, which is directly correlated to stocks. So at some point, I think these yields will get attractive enough to attract foreign investment. And that's going to dramatically slow down the growth of the Fed's balance sheet and also dramatically slow down the potential growth in the S&P 500. But yeah, 2-to-1 ratio, make life easy, and know that we're not just long these positions, we're also protecting them with options.
Okay, thanks.
Yep. And yeah, you can see I have the squiggly line, so it's approximate 50%, 40%, 10. But yeah, I mean, looking at those prices, you could probably go to 300 shares GDX to get closer to that. But yeah, if you did think about this, this kind of leaves that extra 5% we were talking about for bonus trades kind of built into it if you do keep this exact ratio. Okay, follow up. This may be a boot camp question. In order to be ready, should that 5% be open to interactive brokers, or can we keep it at our regular broker? Okay, great question. So interactive brokers is going to be the only place we can play exotic currency pairs, especially in the futures market. So that would be Chinese currency. And we did see some notes that JP Morgan's trying to jump into that. So that might open it up to more general brokerage firms. I'm not going to be shorting the Chinese currency until I see the trade war escalate. So probably don't need it at interactive brokers in the near term future. Probably closer to, I'd get that money in interactive brokers right around the election, assuming that there's no trade escalation. Now, if I see trade escalation, we're going to want to definitely jump in there. FXY, I'll have to check out that, Mark. I'm not familiar with that one. I'll show you the one we're interested in for oops, sorry. Oh, I'll have to find that, but yeah, we're a ways off. CNH against the USD at interactive brokers will be a trade alert probably towards the end of 2020 or early 2021. The Hong Kong dollar you can trade from Thinkorswim with their phone app or with the desktop platform. Cannot do it from their web platform. So that's another bootcamp trade. That one I'm more likely to enter before we short the Chinese currency. So definitely rewatch the two presentations, module 1, module 2 on that, or rather module 2 and module 3 in the boot camp. Right now, our boot camp trades are just simple stocks, 2 English banks, and then 2 large copper companies. So one's mining out of Indonesia and the other's primarily in Mexico. In terms of shorting LQD, you can do that from Ameritrade. All right, guys, any last questions? Well, I wish everyone a happy new year. Thank you for joining us live. Tomorrow we're off. Markets are closed. There'll be no updates, but we'll be back to the TLT on Thursday. So thank you so much for joining us, and we'll see you on Thursday.